Okay, so let's make this topic a bit more interesting by creating a fictitious bank in our fictitious economy, Metrocity, and see how the principle of banking works. So let's assume that in our fictitious economy, Metrocity has an evolved banking structure. Let's assume that the banking system in Metrocity is now flourishing with banks, and the banking sector is highly profitable. Therefore, we too decide to open a bank, let's call it the Bank of Metrocity, to join this highly profitable market. In order to open a bank, we decide to raise 10 million in capital. By raising 10 million in capital, our balance sheet would look like this. So we have cash on the asset side, which is 10 million. And in our liabilities and equity, we have equity as 10 million. As we know, assets is what is owed to the bank, and liabilities and equity is what the bank owes to its stakeholders. Now let's assume that the banking system in Metrocity has evolved to a point where the government of Metrocity has opened a central bank to regulate the banking system to some extent. Let's call this the Reserve Bank of Metrocity. As we saw in warehouse banking, a bank deposits reserves at the central bank to facilitate payments of checks. When checks are presented to the clearinghouse, the central bank debits or credits the bank's account at the clearinghouse. For now, let's assume that the only purpose for banks to keep reserves at the central bank are for the purposes of clearing checks. So for that, let's assume our bank keeps a reserve of $5 million, and therefore the balance sheet would look like this. You have assets of cash of 5 million, deposits at the central bank of 5 million, and your equity remains at 10 million. Now that we've opened a bank, our main objective is to make money, so let's start dispersing loans and accepting deposits. A prospective client comes into the bank seeking an approval for a $1 million loan to open a business. The bank's credit department approves the loan after the due diligence process. Once a loan is sanctioned, the loan is initiated by creating a checking deposit. The balance sheet now changes to assets where your cash remains at 5 million, deposits at the central bank remains at 5 million. Now your loan account increases, your asset increases to 1 million. Your checking deposit on the liability side increases to 1 million. So you open a checking deposit as soon as the loan is sanctioned or disbursed. Your equity or capital continues to remain at 10 million. So we see here that the effect of increasing bank loans has an immediate effect of increasing deposits that adds to the money supply in Metrocity. If by the end of the year the client repays half the amount of the loan, the balance sheet would look like this. Your loans come down to $500,000 and your checking deposits come down to $500,000. The rest of the accounts remain the same. Since the objective of the bank is to make profits, the cash in bank earns no interest, and the bank decides to increase its loans to customers. By the end of the year, by accepting deposits and creating loans, the balance sheet of the Bank of Metrocity would start looking like this. Your loans have now increased to $25 million. Your deposits at the central bank continue at 5 million, so your assets is $30 million. Your checking deposits is $20 million. So your loans are $25 million, your asset side is $30 million, and your checking deposit is $20 million, your capital is $10 million. Your total deposits are $20 million and your capital is $10 million. It's now time for us to calculate how profitable this new banking venture is. Our main source of revenue comes from loans. The rate we charge on loans will vary with the risk profile of each customer. However, let's assume that the average rate that we earn on loans is 15%. If the amount of loans disbursed is $25 million, then ideally we would earn 15% of $25 million. However, in reality, loans go bad. Let's assume that we have an excellent credit department and 95% of our loans are repaid. Of the 5% defaulted, we are able to recover 80%. So given our default rate of 5% and our recovery rate of 80%, our realized yield on loans is equal to the average contractual rate, which is 15%, into 1 minus the default rate, minus 1 minus the recovery rate into the default rate. So we have 15% and our default rate is 95%, so that's 15% into 95% minus 20% into the default rate, which is 5% or 0.05. Now that works out to 13.25. 13.25 is our realized yield. This realized yield times our loan amount gives us our total revenues from loans. So 13.25 into 25 million gives us 3.3125 million. Now we need to compute the costs incurred by the bank in order to determine our profitability. So the bank costs would be costs on the deposits, which are called variable costs. And we would also incur fixed costs, the costs of office premises, furniture, computers, etc. The cost of deposits would also include the explicit interest, which is the rate at which the bank advertises to mobilize deposits. There are also implicit interest costs of deposits, such as the offering of free checking accounts, free ATM transactions, etc. Now, assuming that the bank deposit rate, the rate at which we advertise to the public, the rate at which we accept deposits, if the explicit costs are 4% and the implicit costs are 2%, the total costs of deposits are 6%. Assuming fixed costs are $500,000, let's compute the bank's profitability. So the bank's profitability would be the loans into the realized yield of the loan portfolio minus the deposits into the cost of deposits minus fixed cost, which is 25 into 13.25% minus 20 million into 6% minus $500,000, which really works out to 1.6125 million. And therefore, the bank's return on equity would be 1.6125 million divided by the equity of 10 million, which works out to 16.125%. Now, banks can improve their return on equity by either increasing profits or lowering equity. Increasing profits can be achieved by increasing revenues and reducing costs. Reducing equity is risky, as banks could face bankruptcy. Let's summarize the risks and rewards of each banking variable in a table to see how we can improve profitability. So here we see that we could increase the loan amount by increasing deposits. However, increasing deposits will incur higher deposit rates. We could also increase the loan amount by decreasing reserves. However, in most countries, there is a minimum reserve requirement by the central bank, which we shall see soon. And also deposit clearing will become an issue, which we shall see again. And we can also increase loan rates. However, if we do increase loan rates, the customers would move to competitor banks, and also customers with bad ratings would come to our bank, and thereby increasing our default rates. So that's not a great idea right now. Now, we could also lower costs by lowering deposits. However, lowering deposits means that you would have to lower your loans, which is also not a good idea. We could also lower deposit rates. If we do that, customers will shift to other banks, and we can also lower fixed costs. Now, since our primary purpose here is to study the amount of loans and deposits in the system, let's focus on these two parameters and the constraints that surround them next.